Good morning, everyone. So, let's go over our interest rates for today. We got that. So, single-family homes all about 4% with 2 points. Condos about 4.125. All your government loans, FHA, USDA, and VA are all about 3.75, paying 1 point, and 4.25 will basically pay all your closing costs. Rebate at 4.25, no closing costs, come out nothing out of pocket. Yeah, so rates are trading still very, very low, so that's a good thing. Yeah, before I went on vacation, we talked about this a couple months ago, but the last meeting before I went on vacation, someone asked to kind of revisit the MCC program, which is a program that I'm a big proponent of, and I always push, at least bring it up in our initial consultation with buyers. And I know we're always talking about clients' money, added value. I think it's something everyone should at least bring up with their clients as funds are available, which there are now. So we'll go through the program. I think what you as realtors probably need to know, at least to just introduce the program, kind of the basics. All the specifics, they honestly have to go talk to a tax guy if they want to know specifically what they're saving, but you kind of give this will help you with just a kind of general background of what you need to discuss. Okay. The Mortgage Credit Certificate program, MCC, reduces the amount of federal income tax you pay, thus giving you more income to qualify and assist you with house payment. We'll go into detail how it works. And actually, I sent an email before the meeting to everyone on the MCC flyer that explains in detail how the program works. And in most cases, if you just give it to the client, they can read it, and it explains it pretty well how the program works. Right now, the current allotment of funds might run out shortly. There's about a few million left as of last week. So we might have a little break in funding, but in July, they're expecting 40 million of MCC funds available that will basically take us out to the end of the year. Yes. As long as you didn't close, you have to close with the credit. So if we get into escrow now and they run out of funds and we're closing in July and funds become available and then we close after the fact, that's fine. You cannot reserve funds. You cannot reserve funds. You have to be approved for the certificate at closing. You can't do it after the fact, and you cannot reserve funds. Okay. Participating lenders to the MCC program. So basically, all the major players in Hawaii, you should be able to, do the MCC program. Even brokers who are not on this list but are brokering the loan to like Bank of Hawaii or Central Pacific Bank can do it. So pretty much anybody in Hawaii should be able to attach this MCC program for your client. What you're going to see, you're not going to see mainland lenders, the USAs, Navy Fed. They can't do it. So that's something I pitch, bring up when I'm going against them, is that this program, Navy Federal cannot do or USA cannot do. Yes. Correct, yeah. And we'll get into that. Yeah. Okay, so this kind of, the main point to this program, what you need to understand is the difference between a tax credit and a tax deduction. Okay, so a tax credit is a dollar-for-dollar reduction in your tax bill. And a tax deduction basically is a reduction in your taxable income. So let's use an example of a $10,000 tax credit. So $10,000 tax credit is basically $10,000 you're getting back from the government. Dollar for dollar tax credit. A $10,000 tax deduction is basically a program works. You need to understand and kind of convey it to your clients. Okay, so let's use this example here of a $500,000 loan at 4% and 30 years. So first year, basically, you'll be paying roughly $19,800, $19,839 in interest. So of course, everybody can write that off. That's, for primary residence, that's standard. Everybody can write off the interest. And the assumption for this example is a 20% tax bracket. Down with their tax guide to see exactly what they're going to be saving and how to go about it. Because there's two kind of avenues you can go about it, as is as far as, you could either kind of wait to the end of the year and get a bigger tax, refund at the end of the year, or increase your W-4 withholdings so they're taxing you less during the year and you get more disposable income per month to outplay for the mortgage rate. So that part they have to work with their tax guy, and we never kind of give tax advice. We just, kind of educating them about the program. Okay. Okay, the requirements. Principal residence, so it's got to be somebody's primary residence. They cannot have ownership interest in a property in a principal residence at any time in the last 3 years. So they can have owned rental property, or they could have owned a principal residence 4 years ago. But just for the last 3 years, they can't have owned a principal residence. So the MCC looks at the last 3 years' tax returns and makes sure you haven't had any kind of interest write-off. Okay. A mortgage must be a new loan, cannot be a refinance, and there's a $425 MCC processing fee. There is income and purchase price limits. So it came up a lot over the last, 2 years ago it was about 87,000. So family households of 2 or less is 117 is the maximum income you can make, and 3 or more 137, and a maximum purchase price for Honolulu is 732,692. Okay, recapture tax. Another main important aspect of the program. So any kind of program the government puts on to help, benefit buyers or incentives, they also want to make sure that it's not taken advantage of by people who are, investors or whatnot. So there's always kind of restrictions to these type of programs. So basically, the federal government considers MCC tax credit to be a subsidy. As such, it may be subject to a recapture tax if you sell your home within 9 years of purchase, you sell your home at a gain, or your income increases above specified levels. So this is an important point I always bring up with my clients. The main thing here is this income increases above specified levels. If you go to the next slide, because it's kind of a hard slide to see, but basically what happens is say if somebody wants to sell in 4 years, they're selling within 9 years, so they're subject to the recapture tax. They made money, sell it again. There's this income schedule. That's also a part of that worksheet that flyer I gave you, but it shows that sorry if you guys can't really see, but saying like after the 4th year, as long as somebody's not making more than 150,000, 150, 237, then they're exempt from any kind of penalty. So if somebody looks at their income, state workers, their income's not going to go up that much in 4 or 5 years, then they can still sell the home within whatever year they want to, and as long as their income hasn't gone above that level, then they're not going to be subject to any recapture tax. Like, 5th year, 6th year, it goes up about 5% every year. So that's a conversation I have with the client, and they can decide, what they think as far as their income or future potential income. And what they do, the government, the state looks at time of sale, what you gain, how much you've saved, and they have this calculation of what the tax is going to be or the penalty. They ask me what it's going to be. You can't know at the beginning what the penalty is going to be. But the main thing is if they think, if there's a possibility that they're maybe, it's something they're going to have to decide on their own if they want to take on kind of what they feel with, as far as paying back the recapture tax. How does it affect me? Time frames. It is another approval process with the state, so it could take another week from just getting approval from the state. So we ask for 45 days to be safe. We'll get back to contract special terms. And sellers, as part of the approval process, the seller has to sign 2 forms, one of which has to be notarized. So, the seller got to pay notary costs. And then basically contract, Kalama can kind of allude to this, but we generally, personally, I would like to see it in the contract. I guess it depends how competitive the bidding is, but it's something that, because if we have to delay because of the MCC and it's not in the contract, then we have no rights to delay, or the seller, if we're telling the seller to sign this and it's not in the contract, they may say, well, we didn't agree to sign this. So Kalama can kind of allude on that a little bit.
If you need a special term, it's not in the purchase contract manual, so you have to come to me. I'll get an approved term from James Stone. It's going to be something like, seller understands and agrees that the buyer is participating in the MCC program, and seller agrees to sign all required documentation within 3 weeks prior to close. Something like that. We'll come up with language for you.
They paid it, they owed, like I said, check go back to the slide. Well, first off, is you got to look at what they're making now, right? If you know, like an E78, they're probably making 80, 90,000, and it doesn't go up that much. So as long as they can sell it like after 3 years, and as long as their income is not more than 143, there's no penalty. Yeah. It, it yeah. Try to go back one slide. Yeah. So to pay the recapture tax, um, all three of these requirements have to be met. So basically, you got to sell within 9 years. You sell it again, and the main one is this income's got to be above this amount before it's even an issue. That's like states, like people that are kind of fixed W-2 earners, yeah. But I mean, commission people, maybe they have a good year. That year might, it's a different story. But yeah, they can. Well, then they can pay the penalty. Yes, Tia. Yeah, correct. Yeah. So the question from Thea was if they could that they can rent a home. Yes, and there's no penalty to rent a home. So at any point they can rent a home, but once it stops being their primary residence, they can no longer take advantage of the program. But there's no penalty. And then if they come back 3-4 years later, and now they can use the program again. But it only can be used when they're using the property as their primary residence. And after 9 years, then you do whatever you want. There's no restrictions. MCC is, a lot of these programs have the recapture tax. MCC on its own has this income attachment. Most of them, if you just sell within 9 years, you're going to pay regardless. So the main one is the income. That's what I when I kind of talk to my clients, the same thing. That's the most important one, to kind of see if you're going to be making more than these income amounts. Okay. Some common questions. So this MCC is an attachment to a loan, so it's not an actual loan. So it can be used at any loan we do. Anything, yeah. It's just an attachment to a loan. It's not at all part of a separate loan. Like I said, it lasts for the life of the loan as long as you're paying interest and you're using the property as your primary residence. And we already talked about participating lenders. Yes. For first-time home buyer or somebody that has not owned a principal residence in the last 3 years. Yeah. They also adjusted, yeah. Yeah. Like I said, it was the income limits. Yeah, the income limits have been going up. Yeah. A few years ago it was in the 90s, so they make adjustments accordingly. Like I said, it's always tied to availability. So when funds are available, we push it hard. When it's not, then it's one of those you can't take advantage. No, I wouldn't assume that. Yeah, yeah. If it's closed, they're thinking of selling, probably not a program for them. Yeah.
Okay, I did want to, before we forget, Layne is planning his presentation for Trusted Advisor. And I think we have a really good topic that we always get questions for, and we haven't addressed. And that is comparing pricing, comparing interest rates, comparing fees, and comparing services. Because when our clients talk to a lender, with whether it's Pacific Access Mortgage or if it's another lender, they always think, well, can I get a better deal somewhere else? So the regulations have created a way that you can compare all of that, and Layne is going to go over that and talk about those type of pricing programs and fees in a Trusted Advisor. Did we come up with a date for that yet? Okay, the last Monday of the month, the 30th. So we will send out an announcement for that. We think it's going to be an outstanding topic, and that'll be Monday at 11.